Barrel rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello, I'm Professor Code and this is the Forex Super Model data cycle model for Monday the 8th of the 2nd to Friday the 12th of the 2nd 2021. Basically it's our version of the economic calendar, and let's make a start then. So we've written up the initial stages here. China then, T1 for tier 1, T2 for tier 2. Basically last month we got the data for the whole of the month, January, and then we've got February. We're into the second week now. We've just completed the second week, so 01 to 05 was the first week of January, 08 to the 12th was effectively the second trading week of February. So that's the data we've got. So if we look at January then, tier 1 China -5, tier 2 +10. So we've got a mixed situation. We've got rising tier 2, and then we start again in February, and we've got basically a neutral situation for tier 1 and tier 2. And then in the week we just had, the 8th to the 12th, we've got deteriorating China data, both tier 1 -2 and tier 2 -4. And bear in mind that China is now, as from Thursday till Wednesday next week inclusive, on the lunar holiday. So that gives you an idea of what's happening in the China data cycle. Right, dollar then. Last month, January, tier 1 -5, tier 2 a very strong +24. And then so the first week of January then, the 1st to the 5th, we've got tier 1, an improvement in tier 1 +1, and a reasonable start, a very strong start actually in tier 2 +17. And then this week we've just had the 8th to the 12th, we've got a significant deterioration in tier 1, and we've got an actual relatively deteriorating situation on tier 2. So the dollar, remember, last Friday was non-farm payrolls, which was effectively the start of the downward trend in the dollar. Up until then, the dollar had been relatively strong, bouncing up, and then we had this situation where we got a weak NFP and various Fed comments, and we got this sort of rollover in the USD. And if you look at our sister video for the same dates, the 8th to the 12th, on the weekly analysis review, then this ties in. So basically what's happened here with the dollar is we've got large fiscal stimulus, which in Keynesian terms is known as G plus G, government spending if you like. So they've got an injection of government spending into the economy, and via the Keynesian multiplier, which, without getting into too much technical analysis, basically is basically you don't just get your input, you get a multiplied effect of your input, and it's the reciprocal of the marginal rate of leakage. Anyway, you don't need to know all that stuff, but the gist of it is they've had a massive fiscal injection, which is going to be multiplied via the Keynesian multiplier through the US economy, and arguably, and you're seeing a rise in yields, so we're getting increasing inflationary expectations, and they're trying to run the economy deliberately hot, and they're saying that there's an output gap. In other words, we've got unemployment, so that there's spare capacity in the US economy. Therefore, we're not going to get this. Is going to dampen down any inflation problems. So that's the gist of it. Anyway, we're going to start this now. I'm going to do the next two complexes. So don't go away. Right, welcome back. We're now on to German data and the EUR block as a whole data. So look at the German data then for January. They had strong January. +4 tier 1, +7 tier 2. Then moving into February, week 1, +2 on the tier 1, so maintaining some strength, but deterioration in the tier 2, -4. And this last week, the 8th to the 12th, +2, so a steady tier 1, and a further worsening of tier 2 at -6. So the German data basically was strong in January and has rolled over and is starting to be relatively weak in going forward in February. So the EUR as a block then, so that's all the however many countries it is now, 27 I think. January then, tier 1 -6, tier 2 +5, so a very mixed picture there in January. And then February, the first week, +10 for tier 1 and +3 for tier 2. So a significant improvement in the first week of January in Euro data as a block. And then we've got for this week that's just gone, the 8th to the 12th, +10, +3. So we've got a maturity in the data, a levelling off, so a neutral situation. So therefore the Germany, which is viewed as the engine of the European Union, its industrial base arguably, so we've got a strong January, deterioration in February, and then we've got a mixed January in the block as a whole for the EUR, a strong first week, and we're now starting seeing a levelling off. So that could be lagged from Germany, and you could start to see the block as a whole start to go south, as with the German data. So something to bear in mind. Right, we're going to stop it there and do the next two. Right, welcome back again. We've got the yen, JPY, and the pound, GBP. So let's start with the yen then. January, tier 1 neutral, 0, but very strong tier 2, +17. And then we got the first week of February, 1st to 5th, neutral, 0, 0. Second week, 8th to 12th, tier 1 0 and tier 2 +2. So slight improvement there. So to sum the yen then, JPY complex, in data terms, you've got a pretty strong January, a neutral first week of February, and a slight improvement in tier 2 in the second week of February. So and if you look at the general situation of the yen is obviously the transmission has been significantly beaten down via this equity pump, but the yen has showed some strength because the yen is actually relatively depressed in terms of complexes. So that's where we are there. You've got to look at the data cycle in terms of the equity transmission pretty much at the moment, which is possibly the driving force for the yen. Right, the pound then, January, tier 1 +3, tier 2 +5. Remember we said this was off the back of arguably spurious claimant and unemployment data due to the furlough scheme, but nevertheless we've got relatively robust excuse me, data there. First week of Feb then, 0 tier 1 and +2 tier 2. So we've got mild holding its own, steady to slightly positive, and in the week, the 8th to the 12th, this last week, we've got a slight improvement in the tier 1 +2 and improvement in the tier 2 to +3. So remember what's happening with the GBP. We had that negative rates comment. They're using this as a sort of an insurance policy, a backstop if you like. The data for the GBP is sort of mixed, but slightly erring on the positive, and that negative rates comment certainly did the complex no harm. And if you remember from the complex flows, the pound has been the main recipient of the weaker dollar. So the reverse positive flows going out of the weaker dollar have been basically pumping into the pound. So that's those two. Move on to the next pair. Right, here we go again. CAD this time, Canadian dollar, AUD, Australian dollar. CAD then to start with, January last month, tier 1 +8, tier 2 -1. So you've got a relatively strong tier 1 issue and a slightly weak tier 2. First week of Jan then, -4 tier 1, +2 tier 2. So you've got a significant deterioration in tier 1 data for the CAD, but a reasonable improvement in tier 2. And the 8th to the 12th this last week, tier 1 -4, tier 2 +2. So they've steadied off at that situation. So the CAD, remember, arguably a lot of people link the CAD's fortunes to the oil market. The oil market has really pumped up, and yet the CAD hasn't had the full benefit of this yet. And in terms of the data modelling, arguably you can see why you've had a significant deterioration in CAD data from January through to now in tier 1, and very mild holding the line and slight improvement on tier 2. So that gives you that then. So the AUD then, Australian dollar, January, tier 1 +2, tier 2 +6. First week of Feb then, +3 tier 1, neutral tier 2. And this last month, 8th to the 12th, +3, so steady on the tier 1, but a significant improvement in tier 2. Now Thursday was an interesting one because we had complex flows. We had full complex flows out of the yen. So that's the 7 FX pairs that make up the yen. We're all being bought up because the yen was dropping, and the yen's the back currency on those. So we had a concerted market move out of the yen, and then you had a concerted market move into the Australian dollar, the AUD complex. So you had all 7 AUD pairs being bid, and all 7 JPY pairs from the JPY perspective being sold off. So you had this was sort of full risk on, if you like, on Thursday. And if you look at the data cycle, the AUD not only did it have the equity push and the risk on, but it also had the data cycle in its favour as well. So you had this set. The AUD basically got both barrels. And if you look at the one of the biggest movers, which was the GBP AUD, obviously the AUD GBP AUD, that pair dropped off a cliff over 100 odd points. And if you look at how volatile is my FX pair video that we did, you'll see that the GBP AUD pair is the most volatile FX pair at a rating of ±405. So it was no surprise to see the pound AUD in this scenario with full risk on, yen complex weakness, AUD complex strength, and increasing data in the AUD data cycle, really steaming, and one to be on or looking back was shorting the pound against the AUD. Anyway, there you go. So that's and we'll do the final 2 pairs now. Right, welcome back again. Here we are for the NZD, New Zealand dollar, and the CHF Swiss franc. Right, so the New Zealand dollar then, January, tier 1 +2, tier 2 -2, so mixed. First week of February, 1st to the 5th, improvement in the tier 1 +4, and an improvement in the tier 2 to +2. So we've got improving New Zealand dollar data in the cycle. Last week then, 8th to the 12th, +4 on tier 1, which is steady, and +6 on tier 2. So the tier 1 data is leveling off, but the tier 2 data is accelerating. And if you remember, New Zealand had pretty strong employment data, the 3 monthly data, which pumped the New Zealand dollar. And actually, yesterday, the Friday, we had a sell-off in the New Zealand dollar, as we mentioned in our weekly review. Once the initial complex situation was in the Asian session, was we had a full complex positive move in the dollar and a full complex negative move in the pound. The GDP came out, reversed the pound, and then the market moved its focus towards full complex sell-off in the New Zealand dollar for a while. Anyway, that explains that to a certain extent. The Swiss franc then, January, tier 1 0 neutral, tier 2 -2, so a relatively soft month for the Swiss. But remember, the Swiss franc is at the modelled complex high. It's 76% above the modelled floor. It's the strongest of all the 8 complexes. Now, first week of February, we've got tier 1 is constant as it is in the second week, and tier 2 we've got an improvement in the tier 2 and a further improvement this last week, 8th to the 12th to +4. So in terms of the Swiss data cycle, we've got tier 1 being steady, neutral, but we've got improvement in tier 2 data. But bear in mind that the Swiss franc is pretty much up to its neck in positive flows anyway, at +76%. So let's just make a quick summary of what's been going on then. So China looks as if it's starting to roll over a little bit, and they're on their week's lunar holiday, so just bear that in mind. The dollar then, the dollar had a good strong data pump, and is now starting to look a bit creaky at the top on the data cycle. So the data cycle is starting to roll over a bit. German data likewise starting to creak at the top, and then this is starting to slowly rub off on the EU bloc. So we've got those three. We've got China rolling off a bit, dollar USD rolling off a bit, and Germany, and with a bit of lag, the EUR bloc as a whole starting to roll off. So what have we got? We've got yen. The yen starting was relatively strong and holding in there, but as I say, the yen is basically held hostage to the equity transmission. We've got the pound. The pound is sort of steady to slight improvement, and the pound's been the flavour of the of the markets. If there's any spare positive flows going, it'll have them. So that's what's been happening there. The CAD. The CAD's actually been had a deterioration really in its data cycle, but it's got this sort of tailwind of rising oil prices, and the market will at some stage have a focus on the benefits of these rising oil prices against the data. So watch out for a bit of a bounce in the CAD possibly. The AUD. Now the AUD has come up reasonably well. So the AUD is on the opposite side. It's starting to show a good pump in the data cycle. So watch out for increasing AUD flows. NZD similar, but the NZD was starting off a much higher base. So the one to really watch is the AUD. In our opinion, the AUD has the most to gain. It's got the most elbow room, and the Swiss franc is sort of slowly grinding up. But like we said, the Swiss franc is right up at the 76% mark. It's the most pumped of the 8 complexes at 76% from the model floor. So anyway, I hope that helps. Watch out for the Monday daily briefing. Don't forget, on Monday we've got a light day today. We've got a US holiday with President's Day, and the Chinese are away as well on their lunar break. So watch out for significant try-on moves on Monday, and we're going to try and catch them once we've seen which way the flows are going. So hopefully see you then, and thank you very much.